Hello everyone and welcome to another episode of the VMC Inc. Financial News Network. I'm Victor Campos. So let's take a look at our financial ETFs portfolio here. This is our hypothetical portfolio that we've been discussing on previous episodes. Specifically, we've talked about these Vanguard ETFs because we believe ETFs are the best way to safeguard your money and to make it grow, as we'll explain why in detail, of course. But previously we've talked about the Vanguard BND fund, which is our bond fund. It's composed of various U.S. bonds. That's for a steady source of income. And then we also recommended VYM, which is Vanguard's high dividend yield fund based on U.S. companies for its great dividend return. Let's look at another one in our portfolio that would be very useful for you to own positions in. We're going to look at Vanguard Total Market Fund, which is VTI. And so what we've got in this hypothetical portfolio is we've got one share which we purchased on the first trading day of 2016 for $102.74. On the last trading day, which was a few days ago on January 22nd, the closing price was $96.92. So there we had a loss of value. It's not so good. Since we bought into this fund, we've had a decrease in 5.77%. Well, why would we recommend something that's losing you money? Let's dive deeper into the data, shall we? So I've got my TD Ameritrade account here, my screener, open, and we really recommend TD Ameritrade. Follow the link in the description for a special offer from TD Ameritrade. What I like is the way it presents the data. So this is what we need to look at. We're going to look at VTI, Vanguard's Total Stock Index Market Fund, $96.81 at the closing of the last trading day, January 22nd. It was actually up $2, which was 2.13% from the previous trading day, the 21st. Okay, so let's break down some figures here. This is, according to the Morningstar style box, this is a large cap blend fund. Large cap, it's full of companies with a very large capitalization, so companies that are worth a lot of money, therefore stable. And it's a blend actually of value stocks and growth stocks. So an ETF is a basket of stocks, a collection of stocks from many different companies. Some might be value based and some are growth based. This is a blend and it focuses on those companies that are worth a lot. Whenever you invest in an ETF, there's oftentimes a gross expense ratio because it costs money to make money. But this fund actually has one of the lowest gross expense ratios out there, only 0.05%. So that means, in short, that your money will grow better. There are many funds out there, thousands of them, and some with obscene gross expense ratios. 0.5%, 1%, even higher than that. This is 0.05%. These some other valuable things. The risk is average, and as we know, low risk is usually low return, and high risk is high return. This is average risk, but we've got above average return. At the moment, we are near the low end of the 52-week range. In the last year, the price has fluctuated from $91.79 and $110.90. We're near the low end, and so if you were going to increase any shares in this fund, now might be a good time as of this video. Past performance is not an indicator of future performance, however, and market timing does not work. But in any case, this ETF is a little bit more affordable than it was recently. This ETF has been around since 2001, so it's got some history behind it, as we'll see. The investment seeks to track the performance of a benchmark index that measures the investment return of the overall stock market. So this simulates basically the market in total. And as we're seeing from this 1-year chart, the US market hasn't been the best that it could be compared to other years. So right now we're in the red, possibly the deepest red that it's been in a while. If we delve down further down here, what are the total trailing returns? So looking at things in 1 month perspective, well, we're at a negative 2% return, but in 3 months we've got a 6.25% return. Further out 6 months, we've got a negative 1.5% return. Jumping to 1 year, jumping to 3 years, because this is really, as we've said before, the stock market is a long-term endeavor. 1 month is not enough time for anything meaningful, not even 3 months, not even 6 months, not even 1 year, honestly. You're going to need to be investing for the longer term, such as 3 years. So a 3-year return is 14.66%. That is amazing. 5 years is a very respectable 12.13%, and 10 years is 7.5%. That is a great return on your investment, especially compared to banks and other financial instruments. Let's break down a little bit more of our information here. We'll look at performance. First, we'll look at this in a 1-year increment. If we had invested $10,000 in this fund 1 year ago, we would see that our value of our $10,000 was fluctuating pretty wildly, especially in the big panic of August and September 2015. You saw there that your $10,000 would have been worth about $9,500. Pretty bad. But then notice how it recovered quickly. This is the nature of the market. There's ups and there's downs. There might be a lot of ups, there might be a lot of downs, but it's a long-term thing. Long-term. So let's look at 3 years. This is looking much better. If we had invested in 2013 $10,000, that would be worth over $14,000 if we did nothing else except buy and hold, which is a very viable strategy. Buy stocks or bonds or ETFs and hold on to them. 5 years looks like this, even better. Our $10,000 would be worth around $18,000, and you're probably going to retire in at least 5 years. So think about how much more your money could be worth spent investing it and holding it even longer. Here we see some historical data. In 2011, VTI's market return was 16.45%. In 2012, 33%. In 2013, 12%. 2014, 0.36%. And this year so far, 0.36% as well. Again, past performance does not guarantee future performance. But if we look at things in the longer term, we see a better picture. Let's look at ratings and risk. So in 3, 5, and 10 years, this has got 4 out of 5 stars. According to Morningstar, its risk again has been always average, and its return have been above average, which is always what we want. So here we're bucking the trend, which is usually low risk, low return, high risk, high return. Here we've got average risk, above average return. We've got a beta of 1, which means it goes along with the same fluctuations as the general market. A lower beta would mean less volatility compared to the market, and a higher beta would be more volatility compared to the market in general. So this is, of course, a 1 because it's designed to follow the market. With the ups and the downs, so does VTI follow. Taking a look at the portfolio, this is made up of a variety of stocks in a variety of sectors. This is built-in diversification. You don't want to put all your eggs in one basket. That's what this guards against. We've got cyclical, sector, defensive, and sensitive sectors, various divisions, and going on into the subcategories. So you'll see on the right here, most of the stocks are giant capitalization companies with a lot of money, and then large and medium. Doesn't deal very much with small and micro caps. And usually the average of this fund is about only $41 billion. Let's see further down here, you can see the top 10 holdings. So buying one share of VTI will actually give you a piece of Apple stock, Microsoft stock, Exxon stock, General Electric, Johnson & Johnson, Amazon, Wells Fargo, JP Morgan, Berkshire, and Alphabet, also known as Google. So you'll get a piece of all of these big companies in all of these various sectors. And yes, the year-to-date return as of January 22nd looks terrible. It's all negative with a couple double digits here and there. JP Morgan, Amazon is suffering a bit. Yes, negative values are not good, but with its diversification, you won't have the burden of picking the right stock and losing much more money. This is spread out over different asset classes to help protect your money. Let's look at the chart here. One day, this is what this ETF did, but again, don't worry about the days. 1 month, still not enough. It's going down. Maybe there's a resurgence. Okay, 3 months. It's also downward trend. Let's skip over to 1 year. 1 year has been stable for the most part until the August-September panic. A little bit of resurgence and then a decrease as well. Well, that's not so good. But again, looking at 3 years, that looks much better. 5 years, again, if you had bought one share of the VTI ETF on January 2011, it was worth $67.61, and the latest closing price is $96.81. If you're bad at math, it means you made money, a lot of money. Holding this ETF for 10 years shows similar results. There was, of course, the big economic global turmoil of 2009. Recovery. So if you hold on to this fund for years, it'll be worth the most. But even in a shorter time horizon, like 1 year, you will see that we have dividends. Dividends are extra amounts of cash that you earn from holding on to this selection of stocks. So here we have a 0.508 quarterly dividend. We have another one here, 46.8 cents. And then the next was 50.8 cents, and the most recent dividend was 58.3 cents. So for every one share of the stock that you hold, you're going to get another half a dollar out of it or so on a regular basis. The more shares you own, the more you'll get from that return. So imagine holding it for 10 years and look at all of these dividends. All of these dividends that have been added for simply owning the stock, for simply holding it. So you should be seeing why the Vanguard Total Stock Market Index Fund, VTI, should be one of your ETFs that you hold on to, perhaps in a tax-sheltered financial instrument like an IRA or 401k. And at its current price of under $100, you have no excuse, especially as a beginning investor, to be investing $100 or so monthly toward your retirement. Because remember, only you can make yourself a millionaire. So this has been Victor Campos for the VMC Inc. Financial News Network. See you next time.